Welcome to The Explainer. Today, we're jumping into a really clever financial strategy for Canadian business owners. It's called the Immediate Financing Arrangement, or IFA for short. And you know, at its heart, it's all about one thing: taking a corporate asset that's just sitting there and turning it into a powerful tool for growth. Let's get into it.
Okay, so let's start with a question that I think really hits home for a lot of successful entrepreneurs. Is your corporation rich, but your cash is, well, restricted? You've built up all this value, you've got retained earnings on the books, which is great, but then some amazing opportunity knocks. Maybe it's an acquisition, maybe it's a chance to expand, and suddenly the cash you need just feels trapped.
And this right here really gets to the core of the problem. We're going to call it the capital trap. See, when your corporation pays for something like a traditional life insurance policy, yeah, that money builds value over time. But it also becomes this dormant asset. Those dollars aren't out there working for your business day to day. It's like a hidden tax, not on your income, but on your liquidity. So let's just dig into this idea of the corporate capital trap a little more. We need to understand something called liquidity drag.
You know, this quote just says it all perfectly. You've got value, but it's locked behind glass. That cash value is building up inside your corporate-owned insurance policy, sure, but it's not in your checking account. You can't just tap into it to buy that new piece of equipment or jump on a great real estate deal. It's there, but it's not really there for you to use.
So, what's the fix? Well, that brings us right to the IFA solution and how it's designed to literally unlock that trap liquidity.
So what exactly is an immediate financing arrangement? Well, think of it as a really smart financial setup. The whole point is to keep your full insurance protection, which is important, while at the same time prying open the vault on that policy and turning the value inside back into liquid capital that you can put right back to work.
Okay, so how does this whole thing actually work in practice? Let's take a look at the blueprint, this three-step flow of capital.
This diagram really shows the engine of the IFA. Instead of your money just going one way and getting stuck with the insurer, the IFA creates this continuous circular flow. It's basically a three-way partnership between your company, the insurance provider, and a third-party lender. Let's break it down real simple. Step 1. Your corporation pays the premium on a permanent life insurance policy. Step 2. The policy's growing cash value, and that's the part you can actually access while you're alive, gets assigned as collateral to a lender, like a bank. And then Step 3. Based on that collateral, the lender gives your corporation a line of credit. So the bottom line is, your policy's value isn't just sitting there anymore. It becomes this active, dynamic lever for growth.
Now, this is where the strategy goes from just being clever to being truly powerful. Because it's not just about getting your cash back. It's about these two incredible layers of advantage: major tax efficiency while you're alive, and huge legacy benefits for your estate down the road.
Okay, the first advantage all comes down to a specific little piece of Canada's Income Tax Act, Section 2011C. Now, in plain English, what this rule says is that if your corporation borrows money and then uses that money to try and earn income, like, say, reinvesting in your business, the interest you pay on that loan can be tax deductible. This right here is the engine that makes the whole IFA so financially efficient.
And this slide really shows you what that means in dollars and cents. Let's just look at the numbers. Say you borrow $500,000 at 5% interest. That's $25,000 a year in interest payments. But if that interest is deductible, and let's say your corporate tax rate is around 26.5%, you could get back over $6,000. What does that do? It effectively lowers the real cost of borrowing your own capital.
All right, so that's the amazing advantage you get while you're still growing the business. But what about your legacy? This brings us to what you might call the masterstroke for your estate: the Capital Dividend Account, or the CDA.
This slide shows the beautiful endgame. Remember how the policy has two parts? Well, this is where the death benefit comes into play. When the insured person passes away, the policy pays out a big death benefit to the corporation. A huge chunk of that payout creates a credit in this special account, the Capital Dividend Account. And here's the magic: that money can then be paid out to your shareholders, your family, your estate, as completely tax-free dividends. It is, without a doubt, one of the most powerful ways in Canadian tax planning to get value out of a corporation.
So, how does all this stack up against just doing things the old-fashioned way, like putting money in a corporate savings account or a sinking fund? Which one actually builds more wealth for shareholders over the long haul? Well, let's look at a 20-year model.
Wow. Yeah, the numbers here are pretty stark.
The traditional sinking fund, let's say it gets a 4% return, it grows to about $1.6 million. But the leveraged IFA, where you borrow that same amount and reinvest it at a higher 6% return, that results in a net shareholder value of $2.3 million. That's a $700,000 difference. And this really highlights a huge shift in thinking. It's the difference between just saving your money and actively leveraging it. Your capital isn't just sitting on the sidelines, it's in the game, working and compounding for you.
Of course, it's really important to throw in a quick disclaimer here. These numbers are just for illustration. An IFA is not some kind of guaranteed windfall. You know, interest rates change, investment returns are never certain, and the rules can be updated. This is why professional monitoring year after year is absolutely critical to make sure the strategy stays on track.
So with all this potential and complexity, the big question is, who is this actually for? Who is the ideal candidate for a strategy like this?
Look, an IFA is not for a brand new startup or a business with really unpredictable cash flow. It's built for established, incorporated Canadian businesses. Think owner-managed companies or professional corporations. You need to have that stable, predictable cash flow, a good chunk of retained earnings already built up, and frankly, the ability to fund a pretty significant annual premium, usually in the ballpark of $100,000 or more. And most importantly, it's for owners who think in decades, not just quarters. You're balancing that immediate need for growth with a really smart plan for your long-term legacy.
And that really brings us to our final thought for today. The question you have to ask yourself is this: for a successful, growing business like yours, what is the true cost of that trapped capital? It's not just a number on a balance sheet. It's the deals you had to pass on, the equipment you couldn't upgrade, the expansion you had to delay. It's the opportunity cost of letting your hard-earned capital sleep when it could be out there building your future.